$45,000 more. That's what borrowers closing at 6% in 2025 are paying versus the 3.9% rates from 3 years ago. And the worst part, if rates stay elevated, that cost becomes permanent. In the next 9 minutes, I'm showing you the exact regional closings happening right now. New Jersey at 5.875%, Philadelphia at 6%, suburban Philadelphia at 6.375%, and the break-even analysis that reveals why refinancing might never happen. Because here's what most borrowers don't see: the 7-year hold math that locks $45,000 in losses if the market doesn't cooperate. Let's start with the real data coming from active closings. Mortgage lender disclosures and HUD settlement statements from Q4 2024 into January 2025 show a clear regional pattern. In northern New Jersey, conventional 30-year mortgages are locking at 5.875% for well-qualified borrowers. That's with 20% down and a 740-plus FICO score. Move south to the Philadelphia zip codes, and the rate ticks up to 6.49% flat. Push into the suburbs, Bucks County, Chester County, Delaware County, and you're looking at 6.375% for the same borrower profile. These aren't outliers. These are the rates actual people are signing on actual homes right now. Now let's compare this to 3 years ago. In late 2021, the same borrower profile was locking 30-year fixed mortgages at 3.9%. The Federal Reserve's FRED database confirms this range. The average 30-year fixed mortgage rate in Q4 2021 was running 3.88% to 4.12%, so the rate environment has moved 0 to 2.5 percentage points in less than 36 months. That's not a small shift. That's a structural change in the cost of borrowing. Let's do the math on what this actually costs. Take a $350,000 loan right around the median home price in the Northeast Corridor for a modest family home. At 3.9% over 30 years, your principal and interest payment is $1,671 per month. At 6.65%, that same $350,000 costs $2,099 per month. That's $428 more every single month. Over 12 months, that's $5,136. Over 5 years, it's $25,680. Over 7 years, which is the average hold period for a homeowner before selling or refinancing, you're paying $35,792 more in monthly payments alone. Add in the closing costs you'll pay to refinance if rates do drop, typically 2% to 5% of the loan amount, or $7,000 to $17,500 on a $350,000 mortgage, and your total out-of-pocket cost to get back to that 3.9% rate balloons to $42,792 to $53,292. That's the $45,000 trap right there. But here's where it gets worse. The break-even analysis almost nobody runs before signing. Let's say rates do drop. Hypothetically, they fall back to 4.5% in 2027. You're sitting on a $350,000 mortgage at 6.44%, and suddenly a refi makes sense. Your rate would drop 1.5 percentage points at 4.5%. Your payment would be $1,772, a savings of $327 per month compared to the 6% you're locked into. To recover the $10,000 in closing costs, 2-3% on a $350K refi, you'd need to stay in the home for 31 months. That's about 6 years. Sounds reasonable until you remember you've already been paying $428 extra per month for 24 months waiting for rates to drop. That's $10,272 you lost waiting for the opportunity to refi. So even at a 1.5-point rate drop, you don't break even for almost 4 years, and that assumes rates actually drop. What if they don't? This is the silent risk. Research from Mortgage Market Analysis shows that rate environments can persist for much longer than borrowers expect. The 3.9% environment wasn't a one-month anomaly. It lasted roughly 18 months, from mid-2021 through Q4 2022. The current 6% plus environment could be structural, driven by persistent inflation concerns, Federal Reserve policy, and higher bond yields. If rates stay at 6% for 5 years, your break-even on the 3.9% refi doesn't happen. You paid $45,000 more in interest for a mortgage you never had the chance to refinance. This is where the 7-year hold math becomes crucial. Most homeowners expect to either sell or refinance within 7 years. The National Association of Realtors data shows the median home ownership duration before sale is 7.9 years. If you're planning to hold for 7 years, you need to ask yourself, what's the probability that rates drop enough to justify refi closing costs before I sell? If the answer is less than 40-50%, you're essentially accepting the $45,000 premium as a cost of ownership at this rate environment. Now let's talk about what the market is actually signaling. The Federal Reserve's rate path, based on the dot plot from the December FOMC meeting, suggests 2-3 rate cuts in 2025, but with inflation still above target, the terminal rate where they pause is likely staying in the 4.25% to 4.5% range. That means borrowers who locked at 6% now could see rates fall to 4, 75% or 5. 71%, good enough for a refi but not back to the 3, 9% magic number. A 100 basis point drop from 6% to 5% would generate $97 in monthly savings. After $10,000 in closing costs, your break-even stretches to 103 months, 6 years. That's past most people's expected hold period. So what's the real strategy for borrowers sitting in this trap? First, understand that waiting for sub 4% refi is probably not a sound bet. Refi optionality assumes rates will drop meaningfully below your lock, and the current market structure doesn't support that probability strongly. Second, if you're currently rate shopping and haven't locked yet, the 6% plus environment is telling you something. The cost of waiting is high. Every month you delay in a rising rate environment, your lock rate typically gets worse. The opportunity cost of waiting for a drop is often higher than locking now. Third, if you're already locked in 9% from 2021, congratulations, you own an asset worth $45,000 to $60,000 in present value terms. That's real wealth. Don't give it up for a speculative play on rates. For borrowers forced to lock now at 6% plus, the math is stark. You're accepting a 7-year cost of roughly $45,000 more than the 9% cohort. That's $6,428 per year in excess borrowing cost or $535 per month. That needs to be factored into your affordability and your investment thesis on the home. If you're buying in New Jersey or Philadelphia, and you're expecting to hold for the long term, that $45,000 is baked into your equity schedule. The refi trap isn't a trap you can escape. It's a permanent feature of this rate environment unless rates move in a structurally different direction. The closing cost piece is also critical. When you do refi, you're paying 2% to 5% of the new loan amount in appraisals, title work, origination fees, underwriting, processing, and document preparation. On a $350,000 refi, that's $7,000 to $17,500 right out of pocket. Many borrowers finalize this by rolling it into the new loan, which means you're borrowing the closing cost and paying interest on it for 30 years. A $10,000 refi cost financed at 5% costs you $16,271 in total interest over the full amortization. That's why the break-even analysis matters so much. If you're going to pay to refi, you need a 1.0 to 1.5 rate drop minimum to make economic sense. The bigger picture, 2025 is a year where the refinance window for 2021-2022 borrowers is closed. And for 2025 borrowers locking at 6% plus, the refi opportunity is severely constrained. If you're making a home purchase decision in this environment, understand that the rate you lock today is probably the rate you'll own for the full 7-year hold. Plan your affordability accordingly. Don't bank on a refi saving you. And if you see rates drop meaningfully, say 1.5 to 2.0 points below your lock, then and only then run the break-even analysis and decide if it's worth the $10,000 closing cost to execute. For the full spreadsheet comparing regional rates, the break-even calculator for your specific loan amount, and the rate path scenarios that matter for 2025 refi planning. Check